Here's another reason to avoid treasuries. No, this is not a tech stock in the 90s. This is actually the price return of the long-term treasury bond from 1980. As you can see, it's up about 2,000%. That, my friends, is what a bubble looks like. Okay, so here's our forecast for the year. Here's our mascot. He is riding around in his little red convertible, talking on his cell phone. He's having a little bit of a midlife crisis. He's hoping he'll find himself. I think he will this year. And so we're going to resolve our mid-cycle crisis, in my judgment. So in terms of equities, we do believe that we'll go higher. I am not telling you that I'm going to see a whole bunch of earnings growth this year. I think earnings growth will be fine, But I think the real opportunity for the market is in multiple expansion, which is what we've seen already this year. And you've seen how powerful that is. In terms of size, I really think participation's broad. Small caps are a little bit more expensive than large caps, and you can make a case for them, but they tend to do better in up markets. I think it's all too close to tell. I think everybody's going to benefit this year. In terms of style, after a binary risk-on, risk-off, feelings over fundamentals environment, I think active managers like us come back into value, and so I think active will outperform passive. In terms of domicile, I just showed you how cheap things are overseas. If people get comfortable, again, expatriating some of their dollars and buying foreign assets, then that'll stoke the international markets to be higher returners than the domestic markets. In terms of the U.S., I'm sticking with it. Long-term rates at some point will get higher. In terms of the U.S. dollar, with the relative return opportunities overseas, like I said, dollars may go globe-trotting, and with the Fed staying easy, the U.S. dollar may weaken. It's kind of a tough currency year. I believe that about 51%. I'll tell you that. In terms of bonds, I think credit risk will outperform. Again, corporations are the healthiest maybe that they've ever been, and they should trade that way. And in terms of primary threats, no surprise, perhaps, although oil at 108 is kind of bugging me, but politicians are the primary threat. And here's the reason why. We're not only going through a huge election in the United States this year, countries around the planet are going to have big elections, and the big policy decisions that are not being made cannot be put off indefinitely. And politicians, because of the stimulus measures they had to take in the global economy, really are right in the middle of the global economy. And so at their best, they're sort of unconstructive. At their worst, they can be destructive. So if we get into some policy errors, either in Europe or in the U.S., we could be right back in the risk-on, risk-off soup we were in last year, which I can tell you was no fun. So I think the primary threat are elections and policy decisions. Okay. As we reframe our global economy, and I'm in the third segment, so bear with me. As we reframe the global economy, let's take a deeper look at the issues plaguing the old world economy that have us so nervous, and let's determine what their weight really is in our quest for global prosperity. As we go through this, I'm hoping to convince you again that the objects in the rearview mirror are smaller than they appear. All right, so let's talk about the European crisis. There are actually 3 crises happening in Europe, okay? One is a sovereign debt crisis. Governments borrowed too much money. 2 is a banking crisis. The banks actually bought the government debt. And 3 is a growth crisis. We're spending so much money on interest payments that we can't afford to do anything else. Let's take them individually. First, we're going to conquer the sovereign crisis. Get used to this chart. Let me orient you. On the bottom is your public debt as a percentage of GDP. It tells you how much debt you're carrying. On the y-axis is your fiscal balance. Am I running a deficit or am I running a surplus? Obviously, the more you are in this direction, the worse off you are. The more you are in this direction, the better off you are. Here is Europe. One quick comment. Obviously, Europe is burdened, but France's fiscal position based upon these metrics is worse than Portugal's. Okay? The reason I share that with you is who gets to decide whether your country is in trouble or not? The bond market. Italy has been running 120% debt to GDP ratio for ages. It's just now that people are nervous about it. So the bond market's fickle. It's all about confidence. The bond market decides who's in trouble and who's not in trouble. Well, the bond market doesn't have to do a whole lot of homework to figure out that Greece is in trouble, right? Greece is long past the point of no return. They have 2 options. Either one, they can stay in the euro and deflate their economy by reneging on entitlements, by cutting wages, and by privatizing industry, or they can default and invite those unknown consequences. Now, if I was in charge of Greece, I would default, and I'll show you why. So here is a list of countries that have actually defaulted since 1999. The green bar is the economic growth rate, I think 5 years prior to default. The blue bar is the economic growth rate 5 years after default. And so on average, after defaulting, these economies tend to grow more than twice as fast, right? So the first lesson of this is default doesn't necessarily mean no growth. It actually historically means more growth.